Year to date, we are up 13% in the S&P 500, SPY being the ETF. It's pretty remarkable given how far we crashed in March and April. We're actually now above average against the past 10 years. And if you look at the various year-to-date charts from the past 10 years, we're probably among the top 4 or 5 at this point of the year. This is a visualization of the past 10-year average by this time of the year versus S&P returns. So we could look at this chart and say maybe we expect a bit of a mean reversion because in the first 9 months of the year, we've already given the average return of the past 10 years already. So I think it is normal that we see a little bit pullback, the market taking a breath before moving higher. But my read for the end of the year still remains above double-digit returns for 2025. So I think we could get a pullback, but ultimately we should move higher into the year end. This is a chart that shows the run-up from the 52-week low. So the 0 point here is the 52-week low, and we are measuring how much it's rallied from this point on a rolling 1-year basis. And the bottom chart shows the number of days, the percentage of days spent at the all-time high in the past 1 year. So if we can see that the typically 30% region from the 52-week low is a bit of a resistance point. We moved in this region back in 2012, all the way to 2016, and the market weakened subsequently once hitting the 30%. However, since COVID, this run-up has been much higher. If you look at the 2019 high, that was about 40% from the 52-week low. Post-COVID, 80% from the COVID low. And beginning of this year, we reached 40%. So it seems like because of the quantitative easing and fiscal stimulus, the overall norm has drifted higher since COVID. So 40% market is probably a more normal range now. But still, as we approach the 40% across over the 30% mark, the market will start to consolidate a little bit rather than moving up in a straight line fashion. Also looking at the percentage days spent at the all-time high, we're reaching the 20% mark. And that has been historically a bit of a resistance zone back in 2017, 18, 2020. However, the real peaks usually come as we cross the 30% mark. So we're not quite there yet. I think 25 above is the danger zone, but we're not quite at the euphoric blow off top that a lot of people are saying we are at. We've definitely seen an even stronger streak of all-time high days in the S&P 500 historically. So this is a heat map of the S&P 500 historical returns using SPY, the ETF, as a proxy. What we're looking for here is, because we've got positive returns in each of May, June, July, August, September, which is a 5-month consecutive run, we want to look back in history and see, okay, in the same similar occasions of the past, how did the market do subsequently? It doesn't happen that often, almost none of the times before 2015. And it has happened 4 times in the past 10 years. So 2016, 2017, 2018, we've had positive returns between May and September for every month. So in between those 3 years, we had 1 positive October and 2 negative Octobers. So 1 of 3 was positive. And in 2024, we had the same stretch, positive between May and September, but we had a slightly negative return in October. So overall, 1 out of 4 occasions was positive and 3 were negative. So this means if the history is of any guidance, we could be tilted towards a pullback going into October. Even though there is this saying about buy in October and go away in May, just looking at the actual specific context, we are due a pullback. And it doesn't have to be extremely negative. We only had a very bad return in 2018, but in 2016 and 2024, we were only down 1 or 2 percentage points. So now zooming into the short-term price action. Yesterday, Thursday, September the 25th, SPY actually traded pretty flat during the day. So this measures the cumulative returns after the open. So we're discounting the pre-market action. We opened low and we got bid and then got sold off during lunchtime, but the buy stepped in around the mid-afternoon and we had a flat close by the end of the day. So overall, this doesn't scream extremely bearish. So the action is pretty evenly contested between the bulls and bears during the session. And if you look at the broader market, so SPY, QQQ, pretty much flat during the day. What really went down was IBIT, which is the Bitcoin ETF. So going to noon, things were looking okay, wobbly, but after launch, it got really aggressively sold off. So crypto as a whole is very weak right now. Our model signals using machine learning have suggested near-term risk-off sentiment for Bitcoin as well as Ethereum. At the same time, oil got another strong bid because of the Russian situation. Potentially, there could be a wider conflict with NATO. So in the Middle East, so the oil market is quite anxious about the near-term supply chain disruptions, which could squeeze oil higher. And now looking at a dashboard, what we're looking at for is, so this is the latest price and the last night's close. We're actually measuring the close against its 1 year daily volatility to arrive at a Z-score. A Z-score is simply the standard deviation against that volatility. And crypto was down 1.2 standard deviations from its daily average volatility. So bad, but not insanely bad, even though the outright numbers look quite steep. Everything else was marginally down, but they were all within 1 standard deviation. So really nothing too concerning right now at this point. Even when you see a 4% drop in Tesla, but actually that's just 1 standard deviation from this average volatility. It happens pretty often. So we're not too concerned right now. And we're also looking at where the price is trading below its 52-week high. Most of the assets we cover are well within 10%, if not near the all-time high, so 1% from the all-time high in SPY and QQQ. Bitcoin and Ether are outside the 10% mark. Ether is approaching the 20% bear market region. So crypto is seeing significant weakness, but stocks are actually still well bid. And if you look across to this measures the percentage of the price above the 52-week low, crypto actually nearly 100%, or Ethereum 160% above the 52-week low, which is pretty impressive. So a near-term pullback is still pretty normal in a bull market cycle still. And even if you look across to Max 7s, Google is up 70%, Nvidia up 88%, and Tesla has nearly doubled from its 52-week low. So we are still in a very strong bull market right now. And most of the assets are still above the 52-week moving average, with the exception of Bitcoin, Ethereum, Amazon, Meta, and Microsoft. But all of them are still above the 200-day moving average. So now let's take a look at the actual chart technicals. SPY. So we have this very strong trend line going all the way from May up till now. It had been tested 4 times, and we had 1 intraday breach at the beginning of September, but price have mostly stayed above this trend line. So this is our first support. We nearly tested this trend line yesterday on Thursday, but it still held. So I think staying above this, we can't really conclusively say, okay, a major pullback has begun just yet. Breaching this trend line, closing below it, ideally, would give us a more firm signal, and breaching the 50-day moving average would be a real test for the state of the bull market. What I think is that if we did see the wave three high here, and is the wave three of the a larger degree wave three, the pullback would land somewhere between 620 and 640 in this region. So we have the 50-day moving average just above it, and we have a heavy volume profile just in this region as support. So over here, I do think a lot of people, investors who were sidelines and missed this rally or took profit too early, will be rushing in to buy the dip, getting ready for the year-end rally. For QQQ, our first support comes with the 50-day moving average. Again, it's way too early to say the wave four correction has begun. We've had periods over here where it's consolidating sideways, but actually there wasn't a sustained breakdown in the market. And we eventually resolved much higher from this consolidation phase. So right now I'm looking at, if we did top and if we breach the 50-day moving average, then the 550 region is a strong support with heavy volume profile. And that's the 0.38 retrace of this wave three rally. Again, I do think we are in a wave three of a larger degree wave three. So we are in a very strong bull market. Any weaknesses in the market will be served as a dip buying opportunity rather than a sell the rally regime. Look at bonds. So I think the script has really flipped since beginning of September. What we've seen is the Fed is leaning much more dovish, and the Treasury is issuing much shorter duration notes instead of the longer end bonds. In that context, the overall trend has become more bullish for TLT. First, it broke above this medium-term trend line all the way from mid-2024. So we're doing a little retest of this, but overall you can see that we're breaking above the 200-day moving average. We're seeing a golden cross in the 50-day crossing over the 200-day moving average. And there was heavy consolidation with a heavy volume profile in this region, people accumulating bonds over here, and now it's ready to take off. So my stance has shifted to a much more bullish note from here. I do think this was a wave 4 pullback, and we can see the wave 5 in the low 90s next. Oil has been moving sharply in the past week because of the tension between NATO and Russia. But overall, I do think it's still going to be in a range-bound fashion. So we are seeing potentially a trend line resistance over here with a support region in the 71 area. So this has been well tested. It hasn't managed to break down from here, and we have a trend line here. I think we're largely going to play a range-bound game. It could, even if it breaks out, I think for me to get really bullish on oil, we need to take out this high back in June. And the thing with oil is that while there's the near-term tension going on that could affect the supply chain, the US and Canada and non-OPEC countries are really ramping up the supply, bringing more supply into the market, as well as a ramp up by the OPEC countries themselves, who have a lot of spare capacity to produce more oil. And all of that going into a weaker global economy means that the medium-term outlook for oil is still towards the downside. Now looking at Bitcoin, we don't need to stray too far away from the near-term chart. What I see is that this is wave A, wave B, and wave C top. And this wave C was at the 1.2 extension of this wave A, which is a classic wave C target zone. And we've broken down since then. We breached the 50-day moving average, and we've actually retraced more than 0.786 of the entire wave B, so from A to C here. So that is not very constructive for the overall price trend. I think now there's a heavy risk we're going to breach this low at 106K, and potentially challenging the 200-day moving average next. If you just look at how Bitcoin compares with the G5 M2 money supply, we see that it has followed the money supply shape pretty closely with a 11-week lag. A lot of this is influenced by the dollar. So all of the central banks are printing more money, but at the same time, a weaker dollar has translated into a greater money supply from abroad as well. However, since July, we are seeing a consolidation phase in this money supply. So it's not rising as sharply as it did between January and July. And in the near term, there was a downturn risk over here. So a downturn occurred in July, which has likely weighed on Bitcoin so far. And we can see this near-term price action potentially trending down because of this money supply downturn in July. And what we usually observe is that directionally we can take a lot of clues, but how far Bitcoin can fall because of this downturn or how much it rises because of this upturn is much more volatile, is much more uncertain. You can't really say one for one that if the money supply drops by 1 trillion, then Bitcoin will drop by X amount. So we just have to observe. We just know that this is a headwind for Bitcoin in the near term in the next 3 weeks. So we just have to be very cautious, especially on leveraged positions. And so now getting back to this chart, what I think could occur is that we could have a wave C downturn here that could challenge right below the 100K mark. And that could cause a lot of panic here. So typically wave C is 100 to 120% extension of this wave A and from the top of the wave B. And if we break down this new wave A low here, it's pretty much a confirmation that this wave C is happening, and it could take us down to at least 100K. And 100K is such a psychological mark that if it couldn't get defended, there will be a really sharp spike down, traveling into the mid-70s, mid-90s. So I am very cautious with Bitcoin and crypto generally over here. And I would really want to see a sustained rally from this point, and ideally taking out this wave B high to get the bull market back on track. Ether, so we identify this head and shoulders pattern with the left shoulder in August, the head in late August, and the right shoulder again in September. And this neckline here at the 4,000 mark. So we breached the 4,000 mark, again, another psychological number. And we're now seeing a breakdown of this pattern. So in Elliott wave terms, this is an ABC correction, and wave C again could be reaching the 1.23 extension of this wave A, and we can see, and it has already touched the 3.8K mark. If we get below this, and that would be very bearish if we can't get a support from here. Potentially, this is more a 5-wave pattern, and that's pretty bad because we could touch all the way down to the low 3,000s before the next bounce. So the best case scenario right now is actually just to hold here 3.8K and rally off a bounce, and then we can start thinking about the next bull structure. But if we get below 3.7K, it will really open the door to much lower from here. So I wouldn't want to see that. Solana, so the past week has been brutal for Solana. What we see is that the price is still holding at the support level of this upward channel. It's been touched about 4 times, and it's still holding right now. But the overall shape doesn't look great. And potentially what's happening is that this entire structure could be a leading diagonal. So a leading diagonal is when wave 1 to 5 don't really conform to the usual impulsive measures. We could see 3 waves up and 3 waves down, another 3 waves up. And this wave 3 could be just over the 100% extension of this wave 1. As long as this is not the shortest, it still stand. And wave 4 could be much steeper below the wave 1 high that we normally don't see in an impulsive structure. So I do think if this bearish count is the case, and we could be testing a deeper wave 4, so we could see a bounce and then a deeper wave 4 here at the 200-day moving average. So that actually is almost the scenario we're looking for now, as opposed to a much more bullish impulsive run where wave 3 is in the 300s. Coinbase, we have been risk off for Coinbase for nearly a month now. And what strikes me is that it's really struggled to breach this 50-day moving average. So every time we try to get above, it comes straight back down. And that's not good. And we can't even feel this gap that was created between the wave 2 high and the wave 3 low. So that tells me that potentially the path of least resistance is lower from here, and we can get one more low here in wave 5, touching the 200-day moving average around the 270 mark. So this wave 5 region here would be the 1.38 to 1.76 inverse extension of this wave 4. Robinhood actually reached our wave 5 target, the low end of it at 130. So our wave 5 target was a minimum of 130, which is the 1.38 extension of this wave 4. So from here onwards, of course, it could stretch higher into 140 and even potentially 150, but I think the risk reward is pretty much not there. And with the broader market pullback, we could see a heading lower to challenge the 50-day moving average again. So for now, I'm inclined not to chase this. So gold, GLD reached nearly 350 at the high, which was our wave 5 target in this highlighted region over here. So it has completed all 5 waves. Interestingly, when I looked at my article on gold back in August 2024, I had the target for gold in this cycle as 3,650. It's now trading 3,750, so slightly above. But at the time, it was only trading in 2,000. So that prediction came through pretty well in the past year. Looking at this structure, we've had a pretty big rally of this consolidation base between April and August. I do think we should be more or less looking at a pullback from here. But is it that we are seeing the ultimate cycle top where we are seeing wave 5 or 5 or 5 or 5? It's a little bit too early to be conclusive on that. I know people who use Elliott waves like to predict the tops and predict the bottoms using the counts and stuff. But in reality, they're more wrong than they would like to admit because very often the momentum on either side simply just carries through and keeps going longer than your standard waves when it happens. So I think a better approach is just be practical and focus on the market in front of you and observe where things are trading. If we see a substantial drop, that is an early sign. Maybe we've really had a cycle top. But until that happens, this could easily morph into a more extended run for this wave 5. So I would not bet against it just yet. Apple's pushing past the 1.236 extension of this wave 1. Our target is 264, which is the 1.38 extension. So that's a very standard wave 3 target. And if you look at the relative strength of Apple, in the red day, it's still moving up 1.8% on the day. Pretty strong. So breaking out of this channel, I actually think the real game has begun. We should see momentum carrying it to 260 as a minimum in this rally. Amazon, unfortunately, I am leaning a bit more bearish in the near term, and I did flag this potential chart breakdown this week when it crossed below the 50-day moving average. And our machine learning signal has been risk off this week as well, escaping some of this pain. What I see potentially is this is an expanded flat. All that means is that this wave B rally comes above the wave 3 high. And now in the wave C, we are likely seeing a 5-wave down motion, where this wave 3, almost touching the 200-day moving average, is now at 1.76 extension of this wave 1. So the next bounce is likely a wave 4 bounce, potentially into the mid 220s, and then we should expect one more low below the 200-day moving average, near the 200 mark. If we do get to 210, I do think is a good buying opportunity for the final wave 5. Amazon is still fairly attractively valued in terms of fundamentals. The sticky issue for investors is the growth rate of AWS, but with the huge compute demand and the AI growth, I do think AWS should pick up growth in the coming quarters alongside Google Cloud and Azure as well. Google, I think finally is turning down. It had a very strong run after the legal case got resolved, where Google doesn't have to sell Chrome. And we've done a stretch of over 10 days into this new wave 3 high in a very extended RSI zone. I think we reached RSI 86 over here. That's almost unseen in Google's history. And now we're coming down for wave 4 pullback, which is only natural. I do think we could retest this trend line here, which could give us an entry region for this wave 4 low at 215 to 230, especially if it's touching the 50-day moving average. I think that's a quite good buying opportunity, eyeing for this wave 5 high. Meta, we've had a 3-wave rally in this wave B. So now we're entering the wave C phase of this wave 4 correction. So the wave C should test the 700 to 720 mark as the 100% extension of this wave A. There is heavy volume profile supporting this region. That's another clue for where it could terminate. Once we get this low, I do think it's a good opportunity to buy the dip for wave 5 higher, in potentially over 900. Microsoft, I'm not entirely convinced this wave B high has finished. We could have easily just done the wave A leg of this wave B and pulling back, and we could get another rally into the 530 mark, but that would still be a corrective bounce. Corrective meaning is counter trend. Ultimately, I do think we are heading lower in this wave C of wave 4, and that is just to absorb this ridiculous rally back in May to August. Nvidia, this rally is corrective in my opinion. So it didn't quite reach the wave C target that's typically seen in the wave C rally, but the overall shape alongside the broader market that suggests this should be a wave B top. And if we're looking at wave C here, we're looking at around 160 for the termination. My only concern is that if we get below this level here, below 170, there is a very thin volume profile in this entire 150 to 170 region. So when the price travels down, it could gap down quite quickly here. So Tesla, since Wednesday, I have been warning about a potential pullback from here. So this wave 3 high was already at the 1.618 extension of this wave 1, which is a typical target zone for wave 3. Of course, it can run higher, but the risk reward for chasing it is not that great. And if it pulls back with broader market weakness and with this potential for sell the news of the delivery numbers, if it does pull back more deeply, which I think it can for this wave 4, I think first 400 is a very easy psychological mark to defend. That'll be the shallow end of this wave 4 pullback. And then for the deeper end, I think 380 is a likely termination zone for this wave 4. I'm doubtful we get much below 380 or even breaching this supporting line. The reason for thinking about a shallow pullback is because of the depth of this wave 2 pullback here. So if you think about investor psychology, there was a lot of doubt, obviously back in June, but also in this rally, it petered out into a pretty steep pullback. And a lot of people were really unsure back in July whether Tesla can see a new all-time high this year. So now we've entered a really steep rallying phase. And more people are convinced, hang on a second, I missed the train. I need to get in on this. We're going to go to all-time high of 500. The pullbacks tend not to be too steep because people are becoming more hopeful and looking for the buying the dip opportunity next. And this is really obvious when I post stuff on X. Back here, I said Tesla is set for rallying higher and seeing new all-time highs in the coming month. People didn't believe me. They were getting really fed up with this consolidation and sideways. But now I say we could be seeing a pullback on X. Everyone's saying, no, there's no pullback coming. 500 all the way. Tesla to the moon next. Even though I'm not even suggesting a big pullback. So that tells you about this change in sentiment as the price improves, and it's very typical in every single rally, and inversely in every single sell-off. PLTR, I think there is a chance we are seeing a wave B rally here, which is counter trend. It is not extremely clear at this moment because we still haven't taken out this high. But overall, the short-term trend from the charts perspective, we're looking at a still pretty bullish short-term uptrend. But a machine learning signal taking account of the broader macro as well as the recent price action is more risk-off than my technical read. So overall, probably neutral at this point. Finally, SOXX being extremely bid in September, more bid than I had expected, and it had just been going straight up with the stock indices. Now we're finally seeing a pullback. I do think at a minimum we'll test this 50-day moving average to begin with. But once we get this initial leg down, we can better plan out how far wave 4 could come. So that's it for today. Thank you very much. Speak to you next week.